Hi, everyone. Mike White here. Welcome to this week's vlog post. We're well into January. As we discussed earlier, we're really moving along. Applications are up, refinance for both purchases and refinances. Listing activity has been very strong. A lot of new buyers coming into the market, lots of people coming back who were taking some time off for the holidays. So it's really a pretty exciting time. Lots of momentum despite all the other challenges that are going on in our outside world that we don't need to get into at this point. Um, and one of the things I wanted to bring up this particular week is something that I try to remind people of, especially my private clients, always in January. But I think it's even more important this January to pay a little bit of attention. It is the fact that January always can bring us some hidden credit surprises, some challenges that appear in January that nobody's really looking for or didn't have an intention, but because of purchases made around the holidays, and again, this past holiday season were record online sales, record sales in general, many people spending a lot of money, significantly more money than they have in the past on holiday gifts and things. It really can change the dynamics of your borrowers' profiles. And I know you know that, but I just need to remind you that we need to be looking at not only our pre-approvals, but right now, even the people that we have in under contract who you may have locked somewhere in December, who are closing somewhere in January, who are waiting for that final credit report before closing. We could be dealing with some surprises that could have a huge impact. And this year, even more so, given recent fluctuation in the rate environment. So think hard about your current clients who may have had a marginal credit score or a high DTI to start with, and realize that if they went out despite your warnings and spent heavily on credit cards, there may be some prizes that you've had some people exceeding or really increasing their debt load, and it really could affect their DTI. You may have had some people exceed their credit lines or open new credit lines, which could certainly impact their credit scores that may drop them, uh, not only from the program that they qualified for or the pricing that they qualified for, but also may put them in jeopardy for the loan entirely. And that for people who are dealing with, a conforming loan size, dealing with MI. If you have changes in the credit situation or the credit score, it may impact the MI price or the MI monthly cost to that client, which again could put them in jeopardy. And again, without noting, they may have opened some new accounts or there may be a number of inquiries. Um, all of this stuff is going to require, documentation uh, to deal with that. I don't want you blindsided by the final week or in the final days prior to closing, trying to figure out, oh, now what do we do, either to document or we have to now rescore this thing. Um, and the people who are marginal are not alone. Even people with higher credit scores and no DTI issues also run the risk of being a victim of holiday spending for pretty much the same reasons. They could have, maxed out credit cards. They may have accidentally gone over the limit. They may have borrowed money or opened some new accounts, which may have changed their credit scores a little bit. But the point is in some of those cases, those people were, even with great credit scores and great DTIs, going into more debt and lowering their credit score, even by a few points, may drop them from the program that you have them qualified for. And what if you lock somebody in who's under contract, getting ready to close the end of January? You locked them in prior to Christmas at, let's just say, 2.5 on a 30-year fixed. And between them spending money and increasing their DTI and lowering their credit score because of inquiries or, changing the amount of credit utilization on their credit cards, they no longer fit the top tier program, the top tier pricing. And that rate lock that you have is no longer valid because they don't qualify for that program. And given what's happened to many of us in the market, and we've seen, despite the comeback yesterday and the day before in improving prices, we're still quite a bit lower in the bond market, quite a bit higher in rate for people who may have locked in earlier, mid-December. And what happens if they don't qualify that program? You may be looking at somebody who, again, without knowing it, puts you in a position where you have to reprice that loan and lock it differently because they no longer qualify for that program. They've busted through your rate lock because they don't qualify. And now you've got to redisclose an entire loan and you have to relock it, maybe at 2 3/4, maybe at 3%, maybe worse. And how are they going to react to that information? And how are you going to have the time to redo all of that work or possibly do a rapid rescore? So it's really important. And I know we're out there talking to our customers on a regular basis. And I know we've spoke to them about the holidays. All good loan officers do. They remind people the do's and don'ts of their holiday shopping. But it's a really good idea when you're following up with your people, whether it be your people who are under contract and they're a priority because they're going to be getting that final credit report in the next days and weeks to come. And we don't want any surprises. If people think there's an issue, let's get that credit pulled now and let's see what we're dealing with. But the reality also is for your pre-approvals who are out there shopping, if again with a uptick in interest rates and potentially a down tick in their credit quality or their DTI or their MI position, it may be really important for you to just visit with them and have a conversation about the holidays, because those items are going to be hitting the credit reports. Again, they're shopping in December. Those statements are going to come out and they're going to hit the credit bureaus and may already have. So don't be surprised if, by this. Be aware of this, have the conversation. If you're closing loans from now until the middle of February, you want to make sure that you're not blindsided by this and get out in front of these conversations, because if you don't, you may not have the time. And your job, as the mortgage professional is to have this in your mind so that we can get out in front of these things, because it is possible to correct those situations and get rescored if you have the time to get it done. But if it shows up just a few days prior to closing, even if you can get it fixed, and that's a big if, it's going to be a lot of stress on you and your team, your borrower, potentially the agents involved, and that's not how we want to go. So let's get out in front of any potential challenges. Let's get away from any potentially hidden credit surprises, because nobody likes a surprise, especially when it's going to affect the possibility of them buying a house or will increase the cost of them doing so. As always, you can reach out to me, Mike at imtcoaching.com. We'll talk to you again next week. Take care.